commercial, more solvent than any commercial bank that I know in the United States. Now over to you.
Okay. So on the Alameda stuff, like I've heard arguments about arbitrage, right? But like they were fucking awful traders. Okay. So like I don't buy that argument for 1 second. I would love to see the wire confirmations for Alameda sending Tether 36 billion US dollars to back the 36 billion USDT. I'd love to see it. So I don't buy the arbitrage argument for 1 second. Okay, I know traders at Jump Crypto, and they told me exactly how this shit works. That they don't send the dollars in full. Okay, they send a percentage. They get massive discounts, and they send the vast majority of, I guess, whether you want to call it crypto or dollars in crypto. Okay, so they're mostly sending Bitcoin as collateral to back the tethers, and a lot of it is corporate IOUs as well. All right, and I just think that you need to think about this logically, because there's no way Alameda sent 36 billion US dollars. I'm sorry, and they did not arbitrage. I don't buy that argument for 1 second. And I think what is not discussed often, okay, and I think will become more important as these new stablecoin bills evolve, is that, well, I mean, number one, these stablecoin bills are basically aimed at Tether, right? Like they're an attack on Tether's quote unquote business model, right? They require fast fiat redemptions, which you can't get with Tether, by the way. It's sort of why a lot of particularly offshore crypto firms, exchanges, whatever, have used USDC as an off-ramp, right? And that's why their market cap has imploded this year. Even just the other day, you know, there was 166 or 156, I don't remember, million in USDT issued on Ethereum, and another 100, about like almost the exact same amount, was redeemed or burned from USDC on AVAX and Ethereum. So like you're seeing this USDC as an off-ramp avenue, because you cannot get mass amounts of dollars out of Tether, because candidly, they rely on 3 tiny banks in the Bahamas with tiny balance sheets that cannot handle a company the size of Tether, right? I mean, their newest
So why,
partner,
Tiger, question on this one, why do you think they're using those 3 banks? Is it a
well,
crypto problem, or is it a Tether problem?
Well, okay, so here's the thing too, is like, I know everyone thinks it's a crypto problem. Yeah, there are problems within crypto, but a lot of the problems in crypto are not like quote unquote crypto related. They are traditional finance related. Like this whole problem with Tether is not a quote unquote crypto problem. Okay, it's a liquidity risk problem. It's a counterparty risk problem. It's a key man risk problem. These are all traditional finance problems. These aren't crypto problems. Okay, Tether, for the most part, is a traditional finance company. They're a quasi money market fund, quasi alternative asset manager. They're not a crypto company. They have USDT, which is a token, but the standard operations of Tether are very akin to traditional finance companies. Okay.
Yeah, but banks don't see it the same. If you try and get a bank account, it's virtually impossible for a company like Tether. That's just simply
why is that
not the
then,
case.
though? Well, why is it? I mean, listen, you know this, Simon. Okay, Tether was created because they couldn't get a bank account. Okay, so if they can't get
Tether had a bank account, and it was created so that you could get it from one exchange to another. And they lost their banking, which led to a cycle of stuff that they had to deal with from there. But Tether.
But hold on, the reason why they lost their banking partner, the reason why they lost their banking partner is because the US has pretty much made it radioactive for most banks to deal with anything to do with crypto. I mean, you don't want to be a bank banking Tether in related or connected to anything to do with the United States.
Well, there was also, I mean, okay, so they did actually get bank accounts, but they got bank accounts fraudulently through Signature Bank by faking
No, they started off with
companies and faking shit. Come
the
on, man.
Taiwanese banks. They started off with the Taiwanese banks. Then they had the issue with the Puerto Rican banks. They had this hot potato because they essentially became the bank account for all crypto to crypto exchanges, and they grew so fast. And they went from only having about $5 million and trying to persuade every single exchange that stablecoins are a good idea to companies like Binance becoming huge because they were able to use Tether without having to deal with their banking relationships. And then that led to a bunch of relationships that they lost. And then, as they got bigger and bigger and bigger, they lost these relationships and they had to find others. So even though you talk about small banks in Bahamas, and by the way, this is not me, Tether is just a different kind of risk. USDC has its own risk. Other stablecoins have its own risk. But using a bank trust in Bahamas is a different type of risk to using a fractional reserve bank with deep leverage in the US. They're different types of risk. One is a trust bank where they don't leverage and they don't have the same kind of fractional reserve risk and attack that a geopolitical party like China could do to try and take down their banking system.
Well,
and another has, the backing of the largest government. And as soon as people stop buying those treasuries, then it introduces another type of risk. But a trust bank means that you're not taking the same kind of risk and leverage of a US bank. And I'm not saying one's better than the other. I'm just saying they're different risks to manage.
well, okay. So I've also heard like you can use another stable coin if you don't like this one. Well, like not really. Okay, like 70% of the trading pairs in the market are based on USDT, right? Like you can't really use another stable coin.
Yeah, it's like saying
If you're
on that, but it's a very important point. I just want to point that out. This is an important point. Like when it's like when FTX collapsed, we're like, hey, it's okay. You don't have, you're worried about Binance, you don't have to use Binance, but then who's left?
Yeah, but also like, you guys say, oh, they're out of the jurisdiction of the United States. Well, 40, I think it's like 45% of their market cap is actually overseen by Cantor Fitzgerald. They have 39 billion in U.S. Treasuries supposedly being overseen by Cantor Fitzgerald, which is not too far from the SDNY down New York City. I actually don't live too far from Cantor Fitzgerald's offices. Okay,
They're also a registered
so I'm just saying,
business
you guys say it's not in U.S. jurisdiction. Well, assets could be very easily seized if they wanted to.
It is in U.S. jurisdiction. It's a registered money service business in the U.S. and has to comply with FinCEN's requirements.
Well, I don't know if they comply with FinCEN's requirements, but
they have to because they're a registered money service business.
That's by state. That's by state, the money transmission. And it's just because you're registered with FinCEN doesn't mean you're subject to examinations by anybody.
Yeah, it's a different type of thing, but they have to comply with all the money laundering requirements.
But who's to say that they are?
I don't think they comply with that. I really don't. But all right.
Well, then that's an enforcement issue. If the US want to enforce it, they can enforce it because they're registered with FinCEN.
Wait a minute. Registration with FinCEN is filling out a form and submitting it so that you can access the suspicious activity report terminal. So anybody who says, hey, they're registered with FinCEN, it doesn't mean anything remotely close to being registered with the SEC. And remember, the FDIC, correct, the Office of the Comptroller of the Currency, and the Federal Reserve have all published very explicit, very formidable, very, very ominous warnings to any financial institution in the US that does business having anything to do with crypto, with stable coins or otherwise, to the point where they have to first ask permission to do that. And the reason why the banking agencies are doing that is because they fear systemic risk. It's not of any political pressure. It's not because they don't understand innovation. It's because they fear systemic risk. And thank goodness they're doing that, as far as I'm concerned. And that should be a red flag, again, to everyone. If all the banking regulators say, you as a business, you shouldn't be associated with any of this. And then you look at what's coming in 2024 with, if you walk down 47th Street and use crypto to buy a Rolex, then that business is going to have to report that. And with respect to the exchanges, all the exchanges are going to have to report any transactions having to do with crypto, just like your traditional brokerage firms do that. I mean, why doesn't anybody cheat on their taxes with respect to capital gains of stocks? Because they know that those forms go to the IRS, and the same thing is going to happen in crypto. So there's a reason. There's a reason why all the John Doe lawsuits that the Department of Justice has filed, where they literally just go to an exchange and they say, we've looked at the data analytics of the amount of taxes paid and the amount of transactions that you say you have undertaken on behalf of people. We see an anomaly, so we believe that people aren't paying their taxes. So we're sending a John Doe subpoena, meaning a subpoena to an entity like Coinbase or Binance US or anyone, saying, give me all the accounts from everyone who traded in the last 5 years. So the onslaught is continuing and is fairly robust. And I think that there's meaning behind all that. No one's doing that because they're anti-innovation or
John.
they don't like crypto or they don't like anyone on this call. They're doing it because of systemic risk and the threat to investors.
Yeah, John, 100%. No, if I could comment on that, 100% it's about systemic risk. Because you know what the biggest risk to fractional reserve banking is? Full reserve banking. So having a stable coin that's actually backed by the assets and is not leveraged over is a massive risk to those that are leveraging and taking excessive risk with client deposits, which is fractional reserve banking. It's why you have to have that massive onslaught of stress tests and all that type of thing, because just backing a stable coin by assets is significantly lower risk than leveraging up your bank deposits.
Yeah, just a quick question for John. John, if there was a reputable institution in the United States to adopt a cryptocurrency protocol for utility purposes, would that change your perspective that there is utility in the ecosystem and that cryptocurrency public blockchain does have use case, or would that not change your perspective?
That's a great question, and it's a completely fair question. If the technology were to evolve that it had utility, and that utility could somehow be proven and people weren't investing in it, then I say have at it. Go do whatever you want to do. If Goldman Sachs wants to use a private blockchain to run their back office, go ahead and do it. If somebody wants to use their NFT as the picture for their Instagram account, go ahead and do it. But when it comes to the investment side, then you're creating extraordinary systemic risk. You're creating extraordinary investor risk, and that's why the SEC acts. I don't think the SEC is concerned. And remember, the SEC is 99.9% not political. Just about every person who works there is not any kind of political appointee. It's just looking. So if you want to prove the utility to me, you can find, I wrote an article, a very extensive one. I think it's like 15,000 words, okay, about blockchain and Goldman Sachs and all the different projects, blockchain projects that have failed. And, as I said, one of my friends from a very big a technology company, one of the biggest in the world, just said something very simple to me. John, it's a spreadsheet. Stop acting like it's so innovative. We've had spreadsheets forever. So we can disagree on that, and you might be able to tell me, hey, there's going to be some great utility. Of course, Molly White wrote this great article saying it's not still the early days. And Anthony Scaramucci, again, my close friend of 50 years, comes back and goes, John, you don't know what you're talking about. When the internet first came around, nobody knew what it was going to do, and it took forever for things to really materialize. So I get that. And the big thing I would say is lots of crypto investors, lots of blockchain true believers, they're exactly that. They're true believers. They want to do the right thing. They think this innovation is going to make the world a better place. And I respect that. I just don't agree with it, with their factual assumption along those lines.
Well, John, would you agree that a piece of technology that is backed by, now granted, if you could get the audit requirement and the attestation requirement people are looking for, and you could prove that this was backed by these assets, it is a significantly lower risk profile than a traditional US bank that relies upon leveraging up people's assets, sending it to an investment bank, using collateralized debt obligations in order to slice and dice and insure it by credit default swaps, because you're over leveraging and relying upon the credit risk assessment of the bank to determine how much real estate people should borrow, which then gets put into hedge funds and then gets sliced and diced into a million times over and leveraged up. That's risky. Stablecoins is simply full reserve banking where you have transparency, or in theory you have transparency, if we can get that right, over the assets that are backing it, so that you can understand the risk. We understood the risks with USDC as soon as we entered into the risk that was, the risk of Silicon Valley Bank that was caused by this very same issue of the risks that are created in the US banking system through fractional reserve. This is a movement towards full reserve banking. That's a better product.
I let me take the first part of your argument on. First of all, I completely agree that traditional finance has all kinds of problems. I was at the SEC during 2009. I was at the SEC during the dot-com crash. I was at the SEC when Madoff happened. These are bad things. I would argue that they're aberrations, that for the most part, the banks function very well. Like David said, ultimately people get their money back. People have a lot of confidence in the system. I can't tell you all the risks associated with fractionalized banking. I can tell you that there are a lot of problems that I would find in traditional finance related to the way hedge funds do business, with the way that related to the way that banks operate. I see all kinds of injustices and problems. I don't see private money as a solution to any of that. And so I just don't see that as solving those problems. I appreciate the libertarian notion that, hey, when I do financial transactions, I'd rather the government not know. I'm a big First Amendment guy. I'm a big Fifth Amendment guy. I'm a huge Second Amendment guy. I don't trust the government. If you read most of the
They
articles,
know everything. You're onboarding and offboarding through an exchange, and then you're creating an immutable record of every transaction, and the backing of what is behind that, so that you can analyze the risk and actually know. Because here's the biggest problem with banking: people have no freaking idea of the credit risk that they're taking. They have no idea of what's actually behind it. But with stablecoins, you get to actually know that, and it's a significant improvement.
But wait, Simon. Let me jump in for a second.
Go ahead. Sure.
Let's use the signature bank failure, where one of the largest accounts was Circle and back in USDC.
That's a fractional reserve problem. The stablecoin you were able to assess, and the market in real time was able to depeg and adjust the price based upon knowing how much was at risk with the fractional reserve bank that was
just like it did with Terra, Simon.
Terra's not backed. Terra's not backed by those assets. That's algorithmic. That's a different risk profile.
Go ahead, David. Sorry.
Yeah, I mean, just my point being, let's not forget, like Rand said, the banks weren't protecting, but USDC and the $3.3 billion back to USDC and Circle. My problem here is we're talking about, if everything is believable, and I forgot who said, well, no one's going to make a bank run. Yeah, that's not a defense. At the end of the day, what's going to happen here is true transparency. I agree with Simon. True transparency, if this actually worked and was regulated. Look, I'm probably more pro-government and pro more regulation than anyone on the panel right now. But without that, what we've seen so far in crypto is what we've been told is not true. And if we go back to Tether, back early on to 2021, when the investigations were first releasing the documents, it turned out it was like 7. We were always told it was 1-to-1 back. Then when the documents finally came out, it was like 70% back. Look, that's better than fractional banking. I'm not making the argument.
But why did it become 70% back, David? Because the government confiscated a bunch of money in a fraudulent bank because they were pushed out to the fringes of using crypto capital and shadow banks because they couldn't get serviced within a normal bank.
Well, I mean, one of the banks you dropped off was Deltec Bank.
Drug cartel bank, man.
Exactly. They were forced into shadow banking because they lost their traditional Class A banking.
Wait, let me talk about this for a minute. When it comes to banking, here's the deal in the United States. You have the USA Patriot Act, you have the Bank Secrecy Act, you have about 13 different statutes that relate to anti-money laundering. And all of those statutes essentially say that when it comes to financial transactions, you do not have a right to privacy. Meaning at the SEC, I can find out what your transactions are. at the U.S. Attorney's Office, at the DOJ. I can use search warrants. I can use grand jury requests. I can even use just simple requests. Like at the SEC, you don't even need a subpoena to get your brokerage information. You can do it by voluntary request. The regulated entity has to provide it. So you might not like all of those things, and you might want to debate me on those. And I think that's a lively debate because I don't like all those things either. But on the other hand, I don't like terrorism. And what has happened in terms of terrorism is this idea, they talk about Operation Chokehold. Well, that's a legitimate operation. You're trying to stop the financing of terrorism. And the way that you do that is by monitoring financial transactions. So creating this idea of private money, it just completely, it's anathema to all of that.
John, it's not private money, right? You put your money at a bank. Are you required to know whether your bank is committing money laundering with the bank deposits? Or do you rely upon the bank in order to have a robust AML program? So both of the problems you just explained. So David said, look at what happened with USDC. USDC was perfect market efficiency that priced in a DPEG based upon the risk of fractional reserve banking, knowing that $3 billion was on the line in Silicon Valley Bank, which was a banking failure, a regulated financial institution failure. The second one you talked about was Crypto Capital. Crypto Capital was the bank that was committing money laundering, and therefore the funds got seized and it lost its one-to-one backing. So that's a failure in the traditional regulated system because they were meant to comply with all those things. I'm not saying don't comply with them. Anti-money laundering is a fact of life, and everyone that runs a financial institution has to have very robust AML programs. And one by one, we're entering into a world where you're lucky if you can withdraw your money from a bank. But at least
I just don't see it that way, Simon. I think that most people are very, very secure in their banking. Everyone gets paid back if there's a problem. And the reality is that when it comes to these compliance procedures, well, yeah, that's true. That's true, Simon. And I get it. You know, that's a fear. And, you know, there are only so many options for what you can do with your money, whether you want to put it under your mattress or whether you want to put it with a bank or whether you want to diversify, whether you want to use it for real estate. I get it. But I just don't, I look at these compliance systems. Well, I look at these compliance systems as critical, and so do you. But entities like Tether and entities like Binance and entities like Coinbase, they don't have those compliance systems. You say they do, but I have no way of knowing that.
I'm not saying you do. I think you're right. That's a different topic. We were just talking about.
But what I'm saying is, without those protections, people are worse off than what they could with a bank. And I find it so funny, and again, hypocritical, that you talk about BlackRock and you talk about Grayscale and these big companies doing this Bitcoin spot ETF, when the whole theory behind crypto and Bitcoin was decentralization. And you're just trading one set of very trusted participants with another set of less trusted ones. And I don't understand how the consumer or the customer is benefiting at all. The idea is that, well, this crypto can go up. Who knows? Who knows about any of this trading information, any of this trading data? Who knows about any of it? When you look at something like SafeMoon, 95% of it was wash trades. Talking like 35 trillion of trading between back and forth between yourself. So when you have that sort of fraud, that sort of chicanery, that sort of grift going on in plain view, then I just find it amazing that anyone would want to bet on this other than as a gambling proposition. Hey, I think the scam artists are really good, so I'm going to bet on them. And I get
all of those are being, you know, we have a global virtual asset service provider regime being implemented by Financial Action Task Force. Our industry did all sorts of criminal activities, dodgy activities, all sorts of scams and frauds. But now a lot of traditional financial institutions are looking to get involved. Regulators have decided to catch up. They said this is not something we can ignore anymore. And so they're putting in those regulations. And if you don't follow those regulations as a financial institution, then you get fined, you go to prison, or you fix your issue. And so, yeah, we have to fix these issues of the past. There's no doubt about that. But
For what? What are you fixing them all so that you feel like this is going to create a better banking system for the world?
100%. Full reserve banking. full reserve banking, where you know exactly what backs your digital dollar, and you take
the bank out of the middle, and you can go direct from government treasuries to stable coins that moves and creates an immutable record of your transactions.
Okay, there's not a single crypto-related financial institution that could withstand the kind of scrutiny to give you that kind of guarantee. Full stop.
No, if you're backing a stable coin by treasuries, you have taken the bank out of the middle, and you have full transparency to the limitations of an audit.
The transparency isn't possible because they're never willing to give it.
Okay, what about PayPal? What's the issue with PYUSD?
Well, there's lots of issues with it. The first thing is that at least with PayPal, if you have a transaction with PayPal, just like with Robinhood, you can go buy your Bitcoin on Robinhood. You know, and my good friend Dan Gallagher, who was a commissioner at the SEC, is their general counsel. And you'll at least have a mechanism for some sort of remediation of any problem that you would have. So I see that as better, but I don't see it as any kind of a. I don't understand how you can invest in something that has no balance sheet, no assets, no cash flow, no nothing. I'm a traditional investor. I like to look at something substantive, not a bunch of mathematical.
So, John, these are a lot of different issues. So firstly, is a stable coin an improvement over a bank deposit? And I would say being able to take your PayPal balance and be able to clear it on the Ethereum blockchain is a significant improvement from the clunky, shitty Swift blockchain where you have to prove, it's a significant improvement.
I don't see a problem. Simon and John, when stablecoins aside, I mean, the big institutions, and John, you said you would have no problem with private blockchains, and I'm certainly not cheering for them. But I mean, JP Morgan created Onyx and is moving money market accounts between BlackRock and Barclays. So clearly, if we're just speaking technologically, there are some people you probably trust who do believe that technologically this would be an improvement on speed, cost, and obviously the ability to collateralize those things.
Also, immutable records.
I wrote a lengthy article.
Correct.
I wrote a lengthy article refuting that. I mean, I agree that a private blockchain, again, if you want to do it, have at it. You want to drive from DC to New York with square tires, have at it. But
the public blockchain
I just don't see it. I see most of the blockchain projects as failing. I see all these giant companies. If this was such a magnificent, transformative technology, why isn't the greatest database company in the world, Oracle? Why aren't they talking about it and doing something every day? Why haven't they dedicated huge resources to it? You talk to anyone at Microsoft, for example, and they'll say nobody's doing anything with respect to blockchain. Now, remember, with the internet, Bill Gates got on David Letterman. I was there and I watched him, and he said every single thing we do should touch upon the internet. No one is saying that with respect to blockchain. Nobody cares about blockchain anymore. There's no venture capital money going into it. It's old. It's tired. It's done.
It was designed. It's not even worth the argument, because honestly, like, I don't give a shit about JP Morgan. I'm not cheering for them to utilize private blockchains or anything. But like making the argument like that these companies are not necessarily using it is like making the argument that why didn't Sears use the internet? Why didn't Blockbuster see streaming coming? Because not everybody remains number one forever, and it's just a completely
they all don't get it.
They
all just don't get it.
I'm not even
Microsoft and Google, they just don't get it.
John, for me to be able to protect myself from from your banks in the US, I can own my own Bitcoin. For me to be able to transact, no matter how many bombs you throw across the world, for me to be able to protect myself from your excessive money printing that is going to have systemic risk on the entire world, to me, Bitcoin is freedom, and it creates an immutable record. So if you want a great compromise, rather than hijacking all the financial institutions to do the police work for you because you can't do it, at least you can go from create that immutable record and then just build good systems so that if you want to commit crime on Bitcoin, create an immutable record. It's your choice. 7 years later, you stole it.
I think it's a good place. Don't be sorry. I think it's a good place to end it.
Yeah, I just think we're conflating a lot of different arguments, right? I mean, I can see the argument about transparency and banking on the one side, which Simon's fighting very aggressively against.
John, I agree with you on a lot of things. The place I lose you is where it's just sort of emotionally like this is all worth nothing.
There's no utility, etc.
And listen, that may prove to be the case. Like, I can't tell the future, but I find it surprising that we would say, oh, well, Oracle's not using it. It must be bad when you have Larry Fink on TV calling crypto a flight to quality, and in his yearly investment letter talking about the tokenization of all the assets. And you see, even with Jamie Dimon being one of the most dismissive people of crypto in the world, you see what JP Morgan's doing. Watch what they do, not what they say, creating Onyx, JP Morgan, Coin. And listen, once again, like I'm going to get, people are going to cut this up and say, Scott's cheering for JP Morgan and BlackRock, and like, fuck them, I don't care. The point is, it's really hard to make the argument that this is worth nothing when you have now the largest institutions in the world actually, whether they don't even believe in it and they're just taking a look just in case, they're still spending resources and money to do so. Franklin Templeton massively in this space. Fidelity's been in this space since 2015. Once again, not even cheering the institutions here, just making the point that you can't say it's completely worth nothing, point out one or two institutions that are doing nothing when there are so many who are doing something. I mean, Franklin Templeton has already tokenized $300 million worth of treasury bills, which is now $1 billion AUM. Tiny, nothing. I get that. But these people are making significant moves to get ahead of what could be the next trend. So to say all of this is worth nothing because it's just for criminals or whatever, I mean, I'm sorry, John. I really enjoy these conversations. But that just verges on the angry Elizabeth Warren boomer screaming at the kids to get off his lawn and rap music stinks these days argument. And so I think that some of the most important points that people here make are lost in the aggressive emotional side of dismissing it all as worthless. Listen, Tether could be a complete fucking house of cards. I have no idea. I interview Paolo, many people in this audience who I see here get mad. Scott Melker's interviewed more grifters in this space than any other person. He's shilled literally everyone. If you do 3,000 shows and have 30 guests a week, you're going to interview a lot of people that end up being complete fucking frauds. And that's the reality of the situation. And yeah, it sucks that happens. They get past the filter. But the reality is there's a lot of grifters in this space, but it's been cleaned up a hell of a lot. And it's going to only continue to be cleaned up a hell of a lot more in the future. If Tether goes down, something will replace it. And this will continue marching on as it always has. And maybe that will just be everybody coming back to Bitcoin, which could be a great resolution, to be quite frank, if things happen that way. But I just think it's just a little bit aggressive to just dismiss everything and go back. Pretty soon we're going to be doing spaces, Mario, like in 6 months. We're going to be doing spaces about how AI is only for frauds and criminals and is boiling the ocean and is a useless technology of the future. You know why?
I wouldn't.
Because older people fucking hate new shit. You can rap whenever you want now.
Yeah. Okay, man. You want your mic drop moment? I'll give it to you, John. I'm one of your biggest fans, by the way. Now, I appreciate coming on the space, and I think we disagree on some points. I disagree on. I kind of agree a lot with Scott with what he said here, and I disagree on the Tether concerns are very valid, and I think you digging into it.
I agree with that. Actually, I agree with that. Yeah.
And I think this is a discussion worth having. The utility discussion is if it kind of died a few years ago, but I'm willing to still have it. And if you turn out to be right, then I give up on humanity. But on that note, we can wrap the space. I think it's a great space, and I appreciate Simon, John, and everyone else, and Tiger, and everyone else jumping on.